Hi everyone, welcome to the channel. My name is Home. In this channel, I'll talk about the stocks I think that are attractive to the market. So this year, S&P 500 is all-time high, so is the Nasdaq, and some of the names from the S&P 500 made more than 100%, and some of those notable names are obviously the Palantir, the Robinhood, and then the Aplovin, names like this. But what I found also interesting is there are some names that I was investing last year and they were down going to this year, 2025, and they made significant gains. So some of those names that I was investing and they were in my circle were names like the Lam Research, which did really well this year, the Google, the Applied Material, and these names, some of these names I was also these were my best idea for this year, including Micron, and they did really well. And the few names that I was also in didn't do pretty well. They did actually poorly. So going to the next year, I generally like to look for these stocks. They are generally 52 weeks low. And at the year end, people sell the stocks for the tax harvesting. And if you pick some of those names from there, and if you try to avoid the names, they are absolute value traps. So generally looking for the next 12 to 18 months or 6 months out, some of these names do actually quite well because the expectation for this year for these stocks is really low. And people sell at the year end for the tax loss purpose. So when the selling is done, when no sellers are left, if you pick some of those names and a group of those, they generally do relatively well. So this year, looking from this list, I'm interested in some of these names. The one of these stock is the GoDaddy, and another name is the automatic data processing. And I'm also interested in the Dakers holding. And I think I'm also interested in Chipotle. So why I pick some of these names is because these names are relatively quite cheap based upon their valuation, and they are still growing. So the earnings are growing at least 10-15% looking for the next year. The valuations are relatively very cheap. The expectation is low. When you combine all these things and when these beaten down stocks start going up, you can actually make quite some amount of money. So today I'm only going to talk about the Dakers Outdoor. Was actually doing quite well. If you look up to the start of the 2025, the stock was really 350% up in the last 5 years. And then the growth slowed down. Then the stock crashed really hard. And you can see this year, this is down 49%. So my investing playbook, I like to look for 4 or 5 parameters. So the one I look at the beginning to start the position or something that attracts me is the valuation. When I look at the valuation, the stock is, let's say, the cheap enough, then I like to see how the company will grow earnings for the next year or next 2 years. And if I see the earnings will be still up, I like to buy that stock. But if the stock is cheap, but the earnings are or the earnings expectations are down, then I like to avoid those kind of names. And those names generally tend to be the value traps, which I like to avoid. Now let's look the historical valuation for the recent few quarters. You can see here going to the 2025, the stock was trading 32 forward PE, and from there now it is trading just 15 times forward PE, looking for the next 12 months. And the stock share price is also 50% down, and the price to earning ratio for the next 12 months is also 50% down. It has actually done quite well in this earning quarter. The revenue that is 9% up, and the earning per share, the EPS, that was 14% up for the second quarter, and based upon their fiscal year calendar, which is little weird, 2026 fiscal quarter based upon their calendar. The company did reasonably well. There are some areas where the company actually did poorly. They also slightly lowered their guidance for the next quarter. So let's look some of the segment-wise sales. So the Hoka brand, which is one of their largest brand, that actually increased the net sales for 11.1%, which is good. The Alt brand, which is actually the largest brand, and they generally do well in the winter season, that did pretty good. And the other brands, which is a smaller percent of their total sales, come from the other rest of the brands. And those brands did poorly because the net sales there decreased 26%. And the wholesale channels that actually increased 13%, which is quite good. But the DTC, which means the direct to customers or consumers, that actually down 0.8%. And domestic sales, they were also down 1.7%, which is one of their largest market in terms of revenue. But the international sales, that increased 29%, which is really good. So in my opinion, this is stuck to do well for the next year. I think uh, their domestic sales need to go up. That could be just a small number, maybe just few percentage. But if that increases, I think the stock will be really appreciated. And their DTC sales, they also need to go up. If these two metrics improve, I think stock will go significantly up from here because the stock is really cheap. If these things even further deteriorates, then I think the share price will be further punished. So the next thing before investing in a company that I like to check is the balance sheet. And their balance sheet is really pristine. They do not have uh, any debt at the moment. The company said they had no outstanding borrowings, 1.4 billion, and their inventory is slightly up, but which is not very significant. This is also the parameters you like to monitor. But in terms of the overall balance sheet, they are in a really good shape. And the one thing you have to remember is if the company has no debt, then it's not going to be bankrupt. Yes, the share price can go further down if the fundamentals deteriorate, but they have really nice amount of the cash position, and they're utilizing that cash to actually buy back the share. And then this authorization they are going to deploy further, and they are still buying back their shares. In the last quarter, they repurchased 2.6 million shares of $282 million. And this share repurchase is really a good thing because that helps the share price to move up. Now let's look some analyst estimates, what analysts are thinking in terms of their earning per share growth. So they are already in the 2026 fiscal year, fiscal year based upon their calendar. And the next year, the analysts are expecting the earning per share to be $6.85, and for the following year, $7.77. And I think Hoka will easily beat these estimates, including those buyback numbers. I think they can do much better than the $7.7. I think they can easily do the $8 looking to 2028, which is just uh, about 18 months based upon their calendar. And if you just give the 20 multiples to $8, then you get the share price of $160. And from the current share price, I think the stock can be significantly up. I think it can be 50, 60% up to the end of this year or in the next 18 months. That is my expectation for the Hoka. The chart is still trying to break out this 200-day moving average level, which is around 105. I think if the stock can break from this level, it can go significantly up. But there is a resistance, and in the recent price action, it has actually not been able to break this level, but the share prices are up. If you look the 50-day moving average and the 20-day moving average, and if you look the longer term charts, the monthly data, you can see the share prices are actually in a quite good position in the 50-day moving average. Looks like it's trying to break out, and they are well above the 200 SMA in the monthly chart. So if you look at this uptrend in the longer term chart, it still looks like in the uptrend, and if it can actually break this level, I think share price can trade somewhere around 150, 160 by the end of the year. So this is my thesis for the Hoka, because the stock is cheap. They are still growing. I think the international growth is there, and they can improve the domestic growth if that growth goes slightly up, and the direct sell to the customer, if that number also DTC numbers also goes up, share will be appreciated. They will have probably the 9-10% growth going to the next year. They are buying back their shares. The stock is really cheap, and if you combine all these factors, I think you will get 150 to $200 per share at the end of the next year.